You are currently standing on a mountain of wealth that you are legally and mathematically forbidden from climbing down. If you look at your net worth statement right now and see a number that makes you feel successful, 1 million, 2 million, maybe more, I want you to pause and ask yourself a question that most people find terrifyingly uncomfortable. If the world changed tomorrow, if your income vanished or a true emergency hit your doorstep, how much of that number could actually save your life? By the time we hit the midpoint of 2026, the definition of wealth has undergone a radical and painful transformation. We have been raised in a system that worships the total balance, a culture that tells us a high net worth is the ultimate shield against the volatility of the world. But when you actually run the numbers on where that wealth is located, you realize that most millionaires are effectively broke. They are rich on paper, rich in the eyes of their bank manager, and rich in the stories they tell at dinner parties. But in terms of actual, liquid sovereignty, they are walking on a tightrope with no safety net. This is a deep dive into the liquidity trap, the structural flaw in the modern portfolio that is currently turning high net worth individuals into the most fragile demographic in the economy. We are going to move past the surface level metrics and look at the cold, hard math of asset velocity. Because in the 2026 economy, a $2 million net worth can still mean you are one bad month away from total financial cardiac arrest. The primary offender in this trap is the way we have been taught to view home equity. For decades, the primary residence has been the bedrock of the American middle class, the one asset that everyone agrees is a safe harbor. But in the current landscape of 2026, your home equity is functionally dead capital. Imagine you have a house worth $800,000 and you have worked tirelessly to pay that mortgage down until you have $500,000 in equity. On your balance sheet, that looks like a victory. It looks like $500,000 of safety. But the reality is that you cannot eat your kitchen cabinets. You cannot pay for a medical emergency with your roof. To access that wealth, you have to do one of two things. You either have to sell the house, which takes months and carries massive transaction costs, or you have to borrow against it. And in a high-interest rate environment like the one we are navigating now, borrowing your own money back from the bank at 7 or 8% interest is not wealth. It is a penalty. Most people don't realize that home equity has an investment return of exactly 0%. The house appreciates regardless of whether you owe the bank or own it outright. By locking your capital into the walls of your home, you have taken a massive chunk of your life's work and put it into a vault that is incredibly difficult to open when you actually need the keys. Then we have to talk about the second layer of the trap, which is the traditional retirement account ecosystem. We are talking about 401ks, IRAs, and the various deferred tax vehicles that have been marketed as the gold standard of financial responsibility. You are told to maximize these accounts, to funnel every spare dollar into them because of the tax advantages. And for 30 years, you do exactly that. You watch the balance grow to $1 million and you feel like you have won the game. But what the brochures don't highlight is the massive, invisible wall between you and that capital. This is what I call hope assets. You are hoping that 30 years from now, the tax laws will be in your favor. You are hoping that you won't need that money until you are 65. And you are hoping that the government won't change the rules of the game while you are in the middle of the field. In 2026, the cost of accessing that money early is catastrophic. Between the 10% federal penalty and the immediate tax hit at your highest marginal bracket, you can easily lose 40 or 50% of your wealth just for the privilege of using it before the government says you're old enough. You are a millionaire who is restricted by an age-based curfew. You have the mass, but you have zero velocity. The real tragedy is that this structure is not an accident. The financial system is specifically designed to incentivize you to freeze your capital. The banks want your money in long-term mortgages because it gives them a predictable, long-term interest stream. The government wants your money in deferred retirement accounts because it keeps that capital stable and taxable in the future. The entire architecture of modern finance is built on the idea that you should trade your current liquidity for future promises. And while that felt safe in the predictable decades of the late 20th century, in the volatile landscape of 2026, it is a recipe for fragility. If you have $2 million in net worth, but 90% of it is trapped in home equity and retirement accounts, you are not wealthy. Usted is a manager of a very expensive inventory that you cannot sell. You have high asset mass, but your asset velocity is near zero. Wealth is not a fixed sum. It is a relationship between your resources and your requirements. And if your resources are locked behind a vault door that only opens in 15 years, they are functionally irrelevant to your life today. This is the moment where we have to stop measuring success by the total number and start measuring it by the liquidity ratio. Because the person with $400,000 in liquid, accessible index funds is infinitely more powerful and more free than the person with $2 million of dead capital trapped in the system. Let us look at the hidden friction that actually grinds your net worth down to a halt. When you have $2 million in assets, but most of it is tied up in things you cannot sell, you are not just sitting still. You are paying a carry cost for the privilege of appearing wealthy. In the current economic climate of 2026, we are seeing a phenomenon where the more wealth you accumulate in traditional pillars, the more expensive your life becomes to maintain. This is the taxation of identity. Think about the property taxes on that $800,000 house, the rising insurance premiums that have skyrocketed over the last 24 months, and the constant, relentless maintenance that a physical asset demands. If you are paying $30,000 a year just to keep your frozen wealth from deteriorating, and your liquid income is only $100,000, you are effectively a servant to your own balance sheet. You are working 40 hours a week just to fund the existence of assets that are doing absolutely nothing for your current quality of life. This is where the math of the paper millionaire starts to fall apart. You have the mass, but the gravity of that mass is pulling your monthly cash flow into a black hole. The most dangerous part of this lack of velocity is the opportunity cost of the capital you have chosen to ignore. Every dollar that is trapped in your home equity or locked behind a retirement age penalty is a dollar that cannot participate in the high-velocity opportunities that 2026 is throwing at us. We are living through a period of massive technological and economic shifts where the ability to pivot, to move capital into a new venture, to buy a distressed asset, or to simply fund a career change, is the most valuable asset you can own. But if your wealth is frozen, you are a spectator. You watch the world change, and you see the opportunities pass you by because you cannot reach the lever. You might have $1 million in a 401k, but if you need $50,000 today to seize a life-changing business opportunity, you are functionally as poor as someone with zero. You have to ask yourself if a number on a screen that you cannot touch is worth more than the freedom to act when the stakes are high. Most people will choose the safety of the big number because it feels like a shield, but a shield that is too heavy to lift becomes a liability in the middle of a battle. Consider the reality of a sudden life event in this 2026 landscape. In the traditional wealth model, if you lose your high-paying corporate job, your $2 million net worth should make you feel invincible. But if that net worth is 90% illiquid, the clock starts ticking the second your last paycheck hits. You still have to pay the property taxes on the big house. You still have to pay the insurance. You still have to fund the lifestyle that your frozen assets demand. And because you cannot access your retirement funds without a massive penalty and your house equity requires a bank approval that you will not get without a job, you find yourself in a liquidity crisis. You are a millionaire who is panicking about the mortgage. This is not a hypothetical scenario. It is the structural reality for millions of professionals who have followed the old-school rules to the letter. They have built a fortress that they are now trapped inside of because they prioritized asset mass over asset velocity. They have been told that a high net worth is the finish line, but they never realized that the quality of your life is determined by your margin, not your total. There is a psychological weight to this trap that is rarely discussed in financial circles. When your wealth is inaccessible, you live with a low-grade, constant hum of anxiety. You know that on paper you are doing well, but you feel the fragility of your day-to-day existence. You become more risk-averse in your career because you cannot afford a gap in cash flow. You stay in the toxic work environment longer than you should because your frozen wealth provides no immediate support. You have effectively traded your current agency for a future promise of comfort. And as inflation continues to eat away at the purchasing power of those future dollars, the value of that trade looks worse every single year. The person who understands the 2026 math is shifting their focus. They are no longer interested in the biggest possible net worth. They are interested in the highest possible liquidity ratio. They want to know that for every dollar they own, at least 60 cents can be deployed in under 48 hours without a penalty. That is real wealth. That is the ability to say no to things that do not serve you and yes to the opportunities that do. It is the move from being a passive accumulator of frozen mass to becoming an active architect of liquid power. We have to look at the unrecoverable costs of this frozen model. When you lock your money in a primary residence or a deferred account, you are paying a massive, invisible tax in the form of lost flexibility. Over a 20-year horizon, the difference between having liquid capital that you can reinvest and having trapped capital that sits idle is worth millions. If you had that $500,000 of home equity in a liquid brokerage account earning even a modest return, it would be generating cash flow that could pay for your life today. Instead, it is sitting in your walls, earning zero, while you pay interest to the bank. You are essentially renting your own money from the institution. Once you see the geometry of this trap, you cannot unsee it. You realize that the goal is not to accumulate a mountain, it is to build an engine. An engine requires fuel that moves, not fuel that is stored in a vault that only opens when you are too old to drive. The math doesn't care about the pride of owning your home outright or the satisfaction of a high 401k balance. The math only cares about what that capital is doing for your freedom right now. Let us look at the actual geometry of wealth in 2026 to understand why the total number on your screen is a lying metric. We have been taught to aim for a specific destination, usually a net worth figure that begins with a 2 or a 5, without ever stopping to analyze the quality of those dollars. In the math of the real world, a dollar is not always a dollar. There is a hierarchy of capital that most people never learn until it is too late. At the bottom of this hierarchy is what I call frozen wealth. This is your home equity, your locked retirement accounts, and your depreciating personal assets. This money exists, but it has no velocity. It cannot move to protect you. At the top of the hierarchy is high-velocity capital. This is liquid cash, taxable brokerage accounts, and cash-flowing assets that you control completely. The difference between these two is not just a matter of convenience. It is the difference between being an owner of your life and being a tenant of the financial system. If you have a $2 million net worth, but 1.8 million of it is frozen, your actual wealth, the wealth that translates into freedom, is only $200,000. You are living a life that is 10 times more fragile than your balance sheet suggests. This leads us to the fundamental failure of the traditional 4% rule in the 2026 economy. We have been told for decades that if you have a certain amount of money, you can safely withdraw 4% a year and live forever. But that rule assumes that your wealth is liquid and accessible. If your $2 million is 80% frozen, you cannot withdraw 4% of the total. You can only withdraw 4% of the liquid portion. This means the millionaire with the big house and the maxed out 401k is functionally restricted to a poverty-level income unless they are willing to trigger the catastrophic penalties and taxes we discussed earlier. They are trapped in a high-overhead life with a low-velocity engine. This is why you see so many people in their 50s and 60s who look successful but are clearly exhausted. They are managing the mass of a $2 million mountain, but they are only receiving the trickle of a $200,000 stream. They are working harder than they did in their 30s just to keep the mountain from collapsing on them. They have become the caretakers of their own locked capital. The math of the liquidity ratio is what actually determines your level of sovereignty. To calculate this, you take your truly liquid, accessible assets and divide them by your total net worth. If that ratio is below 20%, you are in the danger zone. You have built a fortress with no exit. In the 2026 landscape, where inflation acts as a persistent headwind and market volatility is the new baseline, having a low liquidity ratio is the financial equivalent of flying a plane with no landing gear. You are fine as long as you stay in the air, but the moment you need to touch the ground, the lack of flexibility becomes a fatal flaw. The person who understands this has stopped chasing the total net worth number and has started chasing the velocity of their capital. They realize that $500,000 in a taxable brokerage account is worth more than $1 million in a 401k because the liquid money is active. It can be moved. It can be used to hedge against inflation. It can be deployed into a high-yield environment in a matter of minutes. It is a tool of offense, while the frozen money is a stagnant defense. There is also a massive hidden cost in the way we have been told to ignore the tax liability of our frozen wealth. When you look at your $1 million retirement account, you are not looking at $1 million. You are looking at $1 million minus the government's future share. You are effectively a partner in a business where the other partner, the IRS, can change the profit-sharing agreement whenever they want. By the time you reach the age of accessibility, taxes could be significantly higher than they are today. You are taking all the risk while the government holds a lien on the reward. This is why the paper millionaire often feels a sense of quiet dread when they look at their future. They realize they don't actually know what they own. They only know what the gross number is. The liquid wealth builder, on the other hand, deals in net reality. They pay their taxes as they go, they maintain control of their capital, and they know exactly how much power they have in their hands at any given moment. They have traded the illusion of a bigger number for the reality of a usable one. We have to confront the behavioral trap of the big number. Human psychology is wired to seek the dopamine hit of seeing a balance grow. It feels good to tell yourself you are a multimillionaire. But that ego-driven metric is what leads to the liquidity trap. You keep funneling money into the frozen vault because it makes the total number go up faster due to the tax deferral. You are sacrificing your current agency for a psychological score. But wealth is not a scoreboard. It is a utility. If that money cannot buy you a Tuesday afternoon off, if it cannot protect your family from a systemic shock, and if it cannot be moved to a more productive environment without a permission slip from the state, then it is not wealth. It is a digital gold star. The shift to a liquidity-first mindset is a move toward a more grounded, more honest relationship with your money. It is the realization that a leaner, faster portfolio is more effective than a bloated, static one. You are not trying to win a competition of mass. You are trying to win a game of freedom. And in that game, velocity is the only statistic that matters. To break free from the liquidity trap, you have to perform a radical audit of your current financial architecture. You have to stop looking at your total net worth as a measure of safety and start looking at your survival runway in a zero-income environment. If you were to walk away from your primary source of income today, how many months could your liquid, accessible capital sustain your current standard of living before you were forced to tap into your frozen assets and trigger the penalties? For many people with $1 million net worth, the answer is shockingly low, often less than 6 months. They have built a castle on a foundation of sand, and the tide of 2026 is moving in. The first step in reclaiming your velocity is to establish what I call the liquidity floor. This is not just an emergency fund. It is a strategic reserve of at least 2 years of essential living expenses kept in high-yield, totally liquid accounts. This isn't dead money. It is the premium you pay for the ability to sleep through a market crash or a career pivot. It is the base layer of your live portfolio. Once your floor is established, you must shift your investment priority from tax-deferred accumulation to taxable accessibility. This is a difficult pill to swallow for those who have been conditioned to hunt for every possible tax deduction. It means intentionally choosing to put money into a standard brokerage account where you pay taxes on dividends and capital gains in real time. It sounds less efficient on paper, but in the 2026 economy, the tax you pay today is the price of the freedom you enjoy tomorrow. That liquid capital is your live portfolio. It is the money that can move at the speed of opportunity. If a real estate deal appears, if a new technology changes the market, or if your family needs to relocate to a different continent, that capital is ready. It doesn't need a government permission slip or a bank's approval. It is a sovereign force. By shifting your ratio toward these accessible assets, you are effectively decreasing your asset mass, but exponentially increasing your asset velocity. You are trading a larger, frozen future for a slightly smaller, totally controlled present. We also have to reevaluate the paid-off home dogma through this lens of velocity. In a low-interest rate world, the advice was simple. Keep the mortgage and invest the difference. In 2026, with higher rates, the temptation to throw every spare dollar at the principal is overwhelming. But every dollar you send to the bank to pay down that 7% mortgage is a dollar that is permanently removed from your liquid control. You are trading a 7% guaranteed return for a total loss of liquidity. You are effectively putting your money into a vault and throwing away the key. The smarter move is to recognize that the mortgage is a hedge against inflation. As the value of the dollar decreases, the real weight of that debt decreases as well. By keeping your capital liquid and invested in productive assets, you maintain the option to pay off the house later if you choose, while keeping the power to use that money today if you must. Liquidity is the ultimate insurance policy, and in a volatile world, insurance is more valuable than a zero balance on a mortgage statement. The final stage of this transition is psychological. You have to be okay with having a lower net worth than your peers if it means you have higher velocity. Your neighbor might have a $3 million estate and a massive 401k, making them look like the victor in the game of accumulation. But if they are stressed, trapped in a job they hate, and terrified of a property tax hike, they are not winning. They are the caretakers of a museum. If you have $800,000 that is 80% liquid, you are actually the more powerful individual. You have more options, more margin, and more peace of mind. You have stopped playing the game of comparison and started playing the game of utility. You have recognized that wealth is not something you arrive at. It is something you inhabit. It is the ratio between what you own and how much of it you can actually use to improve your life today. As we move deeper into this decade, the gap between the paper millionaire and the liquid wealth builder will only widen. The systems that were built to encourage long-term, frozen accumulation are increasingly at odds with the speed and volatility of the modern world. The person who stays trapped in the old model will find themselves with plenty of assets, but very little freedom. They will be house rich and cash poor in a world that only accepts cash. They will be millionaires who are still slaves to the clock. But for those who have the courage to audit their liquidity ratio, to prioritize velocity over mass, and to pay the tax on accessibility, the future looks completely different. They are building a fortress that is not made of bricks, but of options. They are not waiting for a specific age to start living. They are using their capital to fund a life of meaning and autonomy right now. I want you to sit down tonight and look at your balance sheet with total honesty. Identify the frozen assets. Identify the dead capital. Calculate your liquidity ratio and be ruthless with the result. If you find that you are trapped in a mountain of your own making, don't wait for a crisis to start moving toward the exit. Start shifting the flow. Start building your liquid floor. And most importantly, start valuing your time and your agency more than the total number on a computer screen. Because at the end of the day, $1 million you can't touch is just a very expensive dream. But $100,000 in your hand is a plan. The next time someone tells you how much they are worth, don't be impressed by the size of their mountain. Ask them about the speed of their stream. Because in 2026, the only answer that matters is the one that includes everything you can actually use.